Hello, I'm Samriddhi Kumari, and today we are going to analyze a very important institutional innovation in finance inclusion. Why MFIs use group lending. So, let us understand the core problem of microfinance. Microfinance institutions operate in imperfect market. Their clients have no collateral, no formal credit history, irregular income streams. Traditional banks avoid these borrowers due to information asymmetric, adverse selection, and high monitoring costs. So, the fundamental managerial question becomes how can MFIs lend sustainably without collateral and still maintain high repayment rates? This answer lies in group lending, a model popularized globally by Mohammed Yusuf through a Grameen bank. Now, let's analyze this model from an economic and strategic perspective. So, what is group lending? Group lending means loans are given to small groups rather than individuals. The defining feature is joint liability. If one member defaults, others are responsible. Instead of physical asset like land or property, MFIs relies on social collateral, trust, reputation, and community pressure. This shift enforcement from legal system to social system. In simple terms, community replaces the collateral, peer pressure replaces legal enforcement. But why does this work economically? Let's apply economics theory here and understand it in further. From a managerial economics perspective, MFIs faces two major problems. The first, adverse selection. MFIs cannot distinguish safe borrowers from risky borrowers. In group lending, borrowers from their own groups, since members are jointly liable, they select trustworthy individuals. Thus, screening cost shifts from the MFI to the community itself. This is a self selection mechanism that reduces adverse selection. And the second is the moral hazard. After loan disbursement, borrowers may misuse funds, but in group lending, peers monitor each other, regular meetings create accountability, default damages social reputation. So instead of hiring costly monitoring officers, MFIs use peer monitoring. This reduces agency problems significantly for the MFIs. Now, let us understand how group lending is beneficial for MFIs through cost efficiency and the risk management that it provides. So, MFIs operates on a thin margin. If they lend individually, administrative cost becomes too high. Whereas with group lending, one field officer handles multiple borrowers at once. Collection cost also reduces in this scenario. Documentation becomes standardized. This improves operational efficiency. Also, risk is shared among members. If one member faces temporary shock, others support repayment. This stabilizes portfolio risk as well. From a strategic viewpoint, group lending enhances sustainability, scalability, as well as high repayment rates. Now, let us understand why this system works so well. So, group lending works not just economically but behaviorally as well. In small communities, reputation matters deeply. If one person defaults, it causes social embarrassment, loss of trust, and exclusion from future borrowing as well. This activates behavioral biases, loss aversion, social conformity, commitment mechanism. In India, the self help groups supported by NABARD, follows similar principles. Most borrowers are women, which enhances financial discipline, household empowerment, and community solidarity as well. Thus, group lending provides both financial and social returns. It supports the double bottom line, which means profitability plus social impact as well. To conclude this discussion, I want to say this that MFIs use group lending because it is an institutional solution to market failure. It transforms social trust into financial collateral, community pressure into enforcement, collective responsibility into risk management. In an imperfect credit market where formal enforcement is weak, group lending becomes a most efficient mechanism. However, as borrowers grow financially stable, many MFIs gradually shift them to individual lending models as well. So, group lending is not just a poverty tool; it is a carefully designed economical innovation rooted in agency theory, social capitalism theory, and behavioral finance. Thank you so much.